backing the infrastructure layer that powers the next wave of financial innovation technology. Stablecoins, tokenization of private assets, democratization of private assets, agentic payments or finance, and obviously AI. So
there's a very big difference between pricing versus value.
We always ask, is this the right race? Is this the right horse? Is this the right jockey? And crucially, is this at the right odds?
Hi, I'm Tom Guinness and welcome to the Raising Your podcast. Here we go behind the scenes with the people building the future of European tech. Today we welcome Ivan Wong to the show. Ivan is a venture capital investor at Mainset. If you want to learn what it actually takes to fund the next generation of European fintech, you don't want to miss this. Ivan, it's great to have you on the show today. How are you?
Very well, thank you, Tom. Thank you for having me.
So why don't you tell us a little bit about yourself, what's your story and how did you get to where you are today?
Sure, so I'm Ivan Wong. I'm an investor at Mainset. So Mainset, we are a London-based fintech-focused fund. So how I got here, so I come from a bit of a non-traditional background in the sense that I don't have an MBA from Harvard. I didn't do my investment banking at Goldman. But so I started my career 10 years ago. Started off in an alternative asset manager, mostly doing public equities trading on the hedge fund side. And did that for 2-3 years, and then decided to upskill myself, did a master's in data science. And then I joined a large asset manager, again doing mostly public investments. And then 3 years ago moved to Capricorn. So Capricorn is a global investment house investing into financial services, mostly private equity style investments. And I joined the team to build out our venture strategy. And along the way we spun out and formed Mainset. And Mainset, we launched our first fund this time last year, investing into global fintechs.
So what investments have you been part of since joining the team?
To date, we've done 7 investments, about to do our 8th, and we've done 3 follow-ons. We're still relatively early on in our fund journey, but we're building our portfolio deliberately.
And so how would you describe your investment philosophy without using any cliches?
So I'd say when we underwrite an investment, we look at several things. So first, we always ask the question, is the solution or product building being built solving a real deep problem? So clear pain points. Second, we look for durable moats. So is this a defensible product or solution? And third, what's important to us is strong unit economics. So beyond the sort of strong narrative and growth story, is there a real economic engine behind the business? And lastly, we are quite deliberate about pricing as well, which might be less common amongst VCs, but for us, valuation matters. It can be a great company, but if the pricing is not right, it's not a great investment. So those are the few things we look for.
So there's a very big difference between pricing versus value.
Yeah, exactly.
For companies.
And ultimately, we always ask the question, is in the analogy of horse racing, is this the right race? Is this the right horse? Is this the right jockey? And crucially, is this at the right odds?
And so unpacking one point you mentioned on moats, how do you view moats today in the age of AI?
It's a difficult one because AI is developing so rapidly. So it's actually less so about tech moats, especially within fintech. A lot of the times it's a mixture of integration moats. Are you deeply embedded into workflows and therefore it's a sticky product? There's the data moat, distribution moat, and these is usually a combination of all of these. And then of course your tech needs to be good, but to your point, it's hard to find necessarily differentiated tech. To give you an example, if you just look at the wealth space, if you just search for AI or native automation tools for IFAs or financial advisors, you can probably find 20, 30 companies building in the same space. How differentiated is each product or tech? Questionable,
Yeah.
But we all know that it's ripe for disruption, and so each of them have different flavors of sort of moat.
And so what type of companies do you invest in, and how much capital do you invest per investment?
So at Mainset, we invest from seed to Series B. Typically, we deploy between £500,000 to £1.5 million into each opportunity. And at Mainset, our thesis is really about backing the infrastructure layer that powers the next wave of financial innovation and technology. And to give you a bit more context, so with every new wave of innovation, there's always new ways of working, so new workflows, new rails, and new system being built. And all these things, they require infrastructure to be built on top. So that's where our focus is, and that could be anything from stable coins and the real world adoption of stablecoin use cases to tokenization of private assets and the democratization of private assets, to the more frontier, agentic payments or finance, and obviously AI. So all these sort of segments need new infrastructure, and that's where we position ourselves and spend our time focusing on.
So is that what you think the biggest investment opportunity is right now?
There are lots of big investment opportunities within the realms of the infrastructure layer, and I wouldn't think of it as whether it's the biggest investment opportunity, but more so it's a durable theme. So with every wave of emerging technologies, as I said, there's always new infrastructure that needs to be built. And the way I see infra is it's quote unquote adaptive. So with an emerging wave, there's new infra that needs to be built, and then there's then more layers that needs to be built on top. So the opportunities is always evolving.
And looking to the future, what do you think the new thing is going to be beyond this?
So I don't necessarily spend time thinking about what's after AI.
Yeah.
I mean, there's pretty enough that's keeping me busy just within the realm of AI. And I think one thing to note is that in fintech, actually, it's not necessarily when we look at the history, the winners is not necessarily frontier of technology that we need to be investing in, but rather say in the case of AI, how products can adopt AI within this very regulated industry. So how do you make your product work and scale the product within the constraints of compliance and regulations? And so we spend a lot of time thinking about, okay, how does this product get to scale? And with financial institutions, there's always a bit slower.
Right.
So it's about finding the pockets of opportunities within, I guess, in this context of AI, within the realm of AI, and how the AI technologies can be. Yeah, it's more so about just finding those AI technologies that can be scaled through this sort of regulated environment.
What's one belief that you had earlier in your investing career that you now have found is completely wrong?
I would say I was fortunate enough to quite early on in my career, when I started out, as I said, in public equities trading. So I guess the biggest thing I learned very quickly is that you can spend all your time building up a thesis and digging deep into an investment idea. But when you put on a position, when you feel very good about it, and then the next day you get slapped in the face by the markets, and so that really taught me how to be intellectually honest with yourself. And I guess in the case of venture, it's slightly different in that in public equities you don't marry to your positions, but in the case of venture, it's really a bit like a marriage, where it's it's a 7 to 10 year relationship. But that said, I think the lessons there still applies, in that you need to be intellectually honest with yourself, because let's say you invest into a seed round, there will be multiple funding rounds potentially. So when it comes to your Series A, you have to take your previous conviction out of your decision process, and that's what we do. We underwrite each funding round as if it's a fresh investment, so not get blindsided by your previous conviction. Otherwise, it can really hurt your return profile in the long run. Right. If I may add another, I guess, more venture-related one, is that when I started in the venture side, I probably overweighted on the, I guess, tier one and backing, who's backing the business in terms of certain tier one names. I probably over-index on that in the sense, don't get me wrong, their signaling is real. If you're backed by one of the big reputable VCs, is great. Yeah. And don't get me wrong, they are great investors, but then very quickly I learned that they ultimately are also just human beings, and they are susceptible to FOMO, market sentiment, and potentially hype in certain cycles. So the lesson there is really just stick to our investment process and stick to our investment philosophy, and not get carried away by who's backing certain businesses.
So how do you win the great deals as a VC? What kind of unfair advantage sets Mainset apart?
So I think our check size actually works quite well in the sense that we don't tend to lead rounds. So we're actually more collaborative than competitive when it comes to working with other investors. So actually we don't compete often, but rather we get quite a bit of deal flows from other lead investors that we have relationships with, and that actually works pretty well with us. And in terms of what sets us apart, I'd say, so we are a fintech specialist, and so I'll just caveat that if you look at true fintech only funds in London, there are not that many of them. Yeah. And so being a specialist, and we have the backing of Capricorn, which is a pretty large platform in terms of their network and their holdings in various types of financial services business. So when it comes to providing help with to our founders, we're a small team, but we think like a platform.
So what's your framework for a must-back founder? What are the non-negotiables?
The billion-dollar question. So I'll start with the non-negotiables. So with us, it's very important, and it sounds very basic, but as I said, our holding period is 7 to 10 years. So the non-negotiable is when we look at a company, the founder must be someone that we can work with and partner with in the long term, as simple as that sounds. But it's very important that the founder is coachable, and that doesn't mean being agreeable, but being open to feedback and discussion and things is very important. And as for our framework with the founders, it's a bit tricky, because first you've got the parts that are less qualitative, so things like background, or your repeat founder, how much domain experience, all these can be scored on a scorecard, which we have a very comprehensive scorecard to score these factors. But ultimately, a lot of founder evaluation is also more on the qualitative side. So things like grit and passion, you can't really score them on paper. So I don't necessarily have a definite answer in terms of a framework, but it also depends on the types of opportunities. Of course, there's the foundations of things that must have sort of traits are you must be able to articulate complex problems, being able to sell your solution. These are very important traits, and enthusiasm and passion. Those are very important, because you need to attract the right talent, and you will hear a lot about investors saying you need to be obsessive about the problem. all these things are true, but it ultimately depends on sort of what you're building in the segment as well. Because let's say some might say you just need to be an obsessive founder building in a space where it's a growing market. True, but I don't think that's sufficient. For example, if you are building a very specific, let's say, automation in some workflow in a very specific segment or industry, you really need that sort of domain expertise. You need to have lived that experience, understand the pain points. Sure, you can do 1,000 customer reference calls, but it's different until you've lived through that pain points.
Right.
And similarly, if you're building in a very technical space or domain, let's say some sort of esoteric space within blockchain, then you can be an obsessive founder. But if you're not a technical person, you'll probably find a hard time building a complex enough product to solve a very complex solution. So it all depends on a case by case basis.
Just to double down on one of the points that you made, founder being able to sell. How do you distinguish between storytelling skill and real substance?
This is also a tricky one, and especially tricky when you come across a very enthusiastic founder, because then these founders tend to be very good at, and it's a great strength of being able to attract talent, for example, building a great team around them. And you can sort of tell when someone is just quite a salesy person versus someone with genuine passion and about the problem they're solving, which is what matters. But in these instances, it's sometimes quite difficult to spot certain gaps. Let's say you've got an execution gap. So for us, when we come across someone who's very good at storytelling, we always have to pressure test how well they execute in terms of their business strategy, how well they can ship products. And so, by really digging deep into the numbers, looking at previous roadmap and delivery, these are ways we try and make sure when we're backing a founder, we're not just backing the narrative, but there's execution behind it.
Where you come from a non-traditional background for a VC, going from data science and trading into venture capital, how data-driven is the team at Mainset, and what are some of the tools that you and the team use to assess investments?
So at Mainset, we deliberately have been from day one being quite data-driven. So part of the reason why Iotto, who's our GP, hired me in the first place is because at the time he was looking for someone with a very strong data background, also someone who knows investing, who's done some private investments. And just to set a scene a little, when I joined the team, it was at the time where I think ChatGPT just came out, so there wasn't all these sort of Gen AI tools out there. So from day one, we've tried to be very data-driven. So I'll give some examples. So start off with some sort of more low-hanging fruit. So how do we automate the process from screening to outbound sourcing, to the analysis part, and to the whole sort of workflow? How do we make it more automated? How do we make it more systematic and more objective? And as with every VC, we've got our CRM and our data source, and with just those two sources or those two tools, there's a lot we can do. So it's definitely a big benefit that I have a data science background and can program. So what I've been doing is writing a lot of scripts into different workflows and different modules. So as I said, from automating the outbound process, and then to portfolio analytics, mapping out the ecosystem with network maps and mapping out the funding every week and things like that. Step one is on the automation side, and then step two is really on the analytics side. So I also built an internal tool where we ingest all the company's financials, and it does a lot of benchmarking. So when we evaluate a given company, how their metrics, KPIs, and growth, how they perform versus other peers within the same segment and the cohorts. And as we progressed, Gen AI started becoming more popular with their tools. So the obvious thing to do is really to plug in one of the foundational models into this module or tool that I've built. And one example is it just produces an in-depth financial report on the financials for every company. So what would have taken me a day to do deep dives into a given company, I can now do it in literally seconds. And that is very important because for us as a small team, that's a game changer. So if you think about it, before these tools were available, there's always a trade-off between volume and the rigor of the way you analyze companies.
Yeah.
But now with these tools, you can actually do both. So what does that mean? That means that now we are less likely to miss potential hidden gems just because we can't triage a huge amount of opportunities, and therefore opportunities have to be screened out by some arbitrary criteria, and that's no longer the case. So
right.
That really helped with us being able to go through high volume and with rigor as well.
And so when it comes to founders standing out in this data-driven world, how do founders stand out to the folks at Mainset?
I think I will answer this in two fronts. So high quality founders, as I said before, there's the more let's call it CV resume side of things. Strong founders will always stand out because they've done X, Y, and Z. And on the other side, on the business side of things, it's really about showing, demonstrating your KPIs and your growth rates, and traction is very important in this day and age. So right. if you're a strong founder with a strong background, building in a space where there's, as I mentioned, durable moat, strong unit economics, and showing good traction, that's always helpful.
But that traction also needs to be visible. For
sure. And it needs to show up in the numbers for sure. And traction, I think, what many investors might over-index on is just, for example, revenue growth rates, right? Because you can be in a business where you're growing very quickly, but if your cost base is staying the same, if you're not being more capital efficient, then that's not really a strong business. And if your unit economics don't make sense, so ultimately it's traction, but also I would say traction beyond the headline growth. So underneath it needs to have sustainable, goes back to the point about sustainable unit economics.
Right, so it's not just revenue traction, there's lots of numbers underneath that need to be trending in the right direction.
Definitely.
On to the founders that you've backed, how do you like to work with the portfolio companies you've already invested in, and how does Mainset add value beyond just capital?
At Mainset, I'll start by saying we get as hands-on or as hands-off as the founders want. So we always first listen to the founders, and what we've found is with all of the founders is always helpful in terms of how we can help the founders sell, and that's usually in the form of introductions. So we're in a very fortunate position where we have the backing of Capricorn. As mentioned, they have a wide network in the financial services spanning across different segments. So to make it real, one of our portfolio companies who sell to insurance companies, we've made introductions to insurance carriers. Yeah. And another portco of ours, they sell to hedge funds and quant funds, and we've made introductions to actually multiple hedge funds because one of our sister companies host managers, for example. And so these are the, I guess, primary way of how we add value. And of course, beyond that, depending on the founders, sometimes, especially with the earlier stage founders, we try and be a sounding board as and when we can in terms of whether it's go-to-market strategy or finance, where we can give our advice. We'll try to be helpful. And then there's the, I guess, less so important, but it's still available, resources like connections to vendors, leadership program, things like that. Those are all on offer, but I'd say those are less important.
So what do you think the role of a VC looks like in 2030?
So I'll answer this in two ways. So first, taking a step back, VC as an industry, the way I see it will be dominated by, on one end, the large platforms. Mm-hmm. These are the ones with lots of capital, lots of resources,
right.
Generalist, and then on the other end there will be a lot more specialist managers, and anything in the middle, in my view, would not exist, because I think Generalist, if you don't have the resources of the platforms, there's no edge. And
right.
with the specialists, there's always the right to exist, because specialists are needed because they understand the industry. They have the industry specific resources and network, and founders and companies will always need these specialists alongside the big platforms. So that's sort of on one side, and the other side, I think, on a more operational day-to-day, how does a VC look? I have the view that by 2030, and I'm already seeing evidence in the form of tools being built, a job of an associate or an investor would be very different. So a lot of my our current jobs will be automated. So anything from screening, sourcing, evaluation, to even writing your investment memo, those can all be automated, and to a point where the investment memo will take into account your investment philosophy, principle, the way your preference, and your tone of voice. So what does that mean? So I think these are actually good development, especially for smaller managers or smaller teams, because it just levels the playing field. Everyone can be very efficient, can go through higher volume of opportunities. And so it goes back to, so then the role of the VC would be very different, because the focus is no longer necessarily triaging your pipeline, for example, but we'll be focusing our time more on how to build out our edge in the form of building relationships, building trust, and the role would be very different.
So in a data-driven world where more and more of the job is being automated, do you think venture is becoming more founder-friendly or less?
I think it depends on the founders. So yes and no, in terms of more founder-friendly for the ones who've got strong or typical profile a VC is looking for. So those founders, to give you an example, I've heard stories where really strong founders, in terms of their resume, the moment they put on stealth on LinkedIn, they get 100, 200 VCs messaging them, asking for intro calls and things. And so those founders who are building in very, let's say, hot spaces will get a lot more availability of capital and interest from VCs. So definitely more founder friendly for these type. But unfortunately, on the other sort of spectrum, is probably less founder friendly. So I think the theme is really flight to quality, and quality in the sense of if you fit in certain boxes, and unfortunately that's just how it goes, and you will benefit from it.
Right. So even if a founder is an excellent founder building a great business, if they don't fit into a box, they'll get less of this inbound interest, you think?
For sure. And you just have to, I guess, build a good narrative, And strong founders will always be found by some investors. It just means it's a bit more difficult to find, and yeah.
So based on your experience to date, what advice would you give to the next wave of aspiring VCs?
I'll start by saying I actually think our current environment is very encouraging for founders who want to build, because with AI it's super cheap and it's super efficient and super easy to build products. And so anyone with an idea can build a product, and the good thing is you can also scale your company without much resources and capital. So that's very encouraging. And on top of that, we've seen these success stories, big tech companies, AI native companies, having raising big rounds and getting a lot of attention. That's always good for the ecosystem. And so it's a great time to be an entrepreneur. Yeah. So that's super encouraging. And on top of that, we've seen quite a few success stories now with AI native companies, tech companies, fintech, and these success stories are always positive for the ecosystem, encouraging and inspiring the next wave of founders to build. And that applies globally, whether it's in the US or Europe. And in Europe's case, I think we're definitely in a good position because all the great talent is here.
Yeah.
And there's, contrary to what some investors would think, Europe is definitely a large enough market. Sure, US is a massive market, but Europe itself is also massive. So lots of opportunities here.
Outside of VC, what do you do for fun?
Nowadays, outside of my VC day-to-day, I spend 100% of my time with family. I've got a 2-year-old. So, and he's just a bundle of positive and happy energy all the time. Well, when he's not throwing tantrum, it's always fun, just chasing chaos in the best possible way, and dancing to nursery rhymes with him. It's my kind of fun nowadays.
I love that, chasing chaos.
Yeah. Amazing.
If you weren't a VC, what would you be?
I'll probably augment the question slightly, because with a 2-year-old, I do keep thinking, in the age of AI, where if I were to grow up in this era, what sort of things can I do? Because in 10 years' time, a lot of the knowledge work will be automated. So to answer your question, probably something that involves more creativity, in the sense of, it's less knowledge base, is less likely to be automated. Maybe something like a chef, for example. That is a good, I love food, I love cooking, and it's a combination of craft and creativity.
So what's the funniest thing you've heard during your time as a VC?
I'm not sure about funniest, but when I sort of started in this, I've had a few instances where I asked for historical financials, and I get the sort of weird comments saying this is off market, and why are you asking for historical financials, and these are not pre-revenue super early stage companies. These are actually companies that have had traction and stuff, apparently, and these tend to be more the US folks. And I'm not sure if it's funny, but it's definitely interesting in that these are weird things to ask for.
Yeah, that's a bit bizarre.
Yeah.
And I'm sure they probably didn't get your investment. No, I'm not surprised. What are your top 3 films of all time?
I'm a massive Chris Nolan fan, so The Prestige, Inception, Interstellar, these are all great films. If I have to give a finance one, though, I think Margin Call is one that is quite underrated.
What books would you recommend to others?
If it's a finance book, then this is actually recommended by my colleague, Michael Porter's Competitive Strategy. I think in this day and age, it's an old book, but it's timeless. With every wave of innovation, what doesn't change is the way you analyze industries and competition, and it just gives you a very structured framework and the way you think about strategy and competition. So highly recommended. And a non-finance book, currently I'm reading a book written by this gentleman called Gabor Mate. It's called, I think it's called Hold On to Your Kids. So it's actually quite thought-provoking, especially as a young parent, you know. Things that you don't really usually think about, you know, your growing up, childhood, so what you're lacking and stuff. So highly recommended for any new parents or to-be parents.
How do you balance being a parent and a high-performing VC?
So it's a hard one. It's you just have to accept that you won't get much sleep in the first 2-3 years. So you survive on loads of coffees and just do your best and always be present and enjoy the moments.
Who's your celebrity lookalike?
Brad Pitt. Well, actually,
Perfect.
you know, to be fair, with the AI tools out there, I won't be surprised if I can, you know, prompt my way through to being a Brad Pitt. And actually, maybe tonight when I go home, I'll find an AI tool. I'll take an image of myself and send it to you and see how close an AI can do with, you know, turning me into Brad Pitt.
Well, Ivan, thank you so much for joining us today. It's been a pleasure having you on the show.
Pleasure. Thank you for having me.
I have a quick favor to ask you. Raising Europe is a community-supported channel. If you find that our content has been valuable to you or has helped you in any way, please hit the subscribe button. It's one quick, free, easy way for you to support the channel and help us make our production better each and every week. Thank you so much for joining us on our journey so far. Without you, none of this would be possible.